Markets continue to be volatile amid all this trade uncertainty, but for investors who are looking to diversify their portfolios, what role can commodities play in that portfolio? Joining us now to discuss, Hussein Aladina, Managing Director and Head of Commodities with TD Asset Management. Hussein, always great to have you on the program.
Thanks for having me.
These are very interesting times, if I can put it that way, and it can be stressful too for investors watching these markets. Let's talk about commodities and the role that they can play in all this.
Yeah, so I think over the course of probably the last 20 years, the need for diversification in a portfolio was tempered by the fact that equities and fixed income afforded that negative correlation. I think this year, late last year, arguably into the future, we're going to need more diversification in our portfolios. Commodities have definitely had a challenging April, to be clear. But year to date, benchmark commodities, the Bloomberg Commodity Index is flat, maybe down 1% compared to equities that are off 17. And that has largely to do with the fact that commodities are coincident indicators. They reflect the supply and demand, or attempt to reflect the supply and demand today, whereas equities and fixed income are anticipatory. Again, for the better part of the 20 years into COVID, you didn't maybe need diversification because inflation was well behaved, allowing for that negative correlation. The reason that investors have and continue to seek commodity derivatives in their portfolios is largely for that negative correlation that they afford to equities and fixed income, and importantly, the positive beta or the positive relationship that they exhibit with inflation. If we're moving into an environment where inflation is going to be more elevated, more volatile, commodities are one of the things that hedge against that volatility.
Now, obviously, we've seen a lot of volatility, and that has led to bear markets across indices that were hitting record highs only a couple of months ago. Balanced portfolios, if we're talking this space, what do they perform like historically coming out of market sell-off like we've had?
So if you look historically at sort of what the optimal allocation to commodities should be, through time, the math will suggest an allocation of between sort of 4 and 10%. If you look at a portfolio that has commodities, so commodities by themselves afford equity-like returns, but higher volatility. So looking at it in isolation, I'd rather be long equities. If I'm picking one asset, I'd rather be long equities versus commodities because the Sharpe on equities through time is higher. But because commodities afford that negative correlation, when you add that into your portfolio, you're improving the efficient frontier, or you're getting better return for any given level of risk. If you look over the course of the last 30, 40 years, a 60-40 portfolio that has 10% commodities has a shallower drawdown, right? And that's important, I think, in today's environment. From 1970 to present, a 60-40 portfolio with a 10% allocation to a passive commodity index has resulted in a shallower drawdown 66% of the time. So you're able to temper the sort of damage in environments where things get challenged.
When I take a look at the commodity space, once you start to dig in, you could be talking about how gold's been reacting,
Yep.
Oil's reacting in a different way along with some of the other metals. But behind all this, of course, once we get through the noise, is about supply out there of these key commodities. You take a look at the tight supply space that we're in right now, I think is the argument you're going to make. What does it all mean?
Well, I think it's important, right? Over the course of the better part of the last 10, 12 years, commodity prices have been challenged. That's a very normal part of the commodity cycle where we're exploiting the investment that we made in the early 2000s. Today, what the market is debating or trying to get a handle on is how challenged demand is going to be on the heels of the tariff sort of tensions that are hopefully at a peak. The supply side matters, Greg, but if there's no demand, and we've joked about this, right? There's no whale oil supply, but there's also no whale oil demand, so it doesn't matter, right? Today, the market is trying to discount how challenged GDP is going to be and whether it's going to be challenged enough to have the supply side act as a constraint. When we look at commodities like oil, you're seeing concerns on the demand side because of the tariffs at the same time that OPEC is adding more barrels than expected back to the market, and that's why oil is
What was that all
up.
about? I wanted to talk to you that day. What was that all about?
Yeah, so I think it's a couple of things, right? And I don't know the answer. If I look at the fundamentals, year to date, inventories have been tighter than the market expected. So if I'm giving you the bullish pitch, it's like, look, OPEC is bringing barrels back to the market because the market needs it. And you see that in the backwardation that we've seen in WTI and Brent, et cetera. And that tighter balance is a function of demand being a little bit stronger than expected, and supply, particularly out of Venezuela, disappointing on the heels of sanctions. There's also an argument that OPEC producers outside of Saudi, Kuwait, UAE have not complied with their quotas. So is this a way for kind of the core three OPEC members to punish the rest of OPEC? Maybe there's an element to that. There's also speculation that President Trump is going to be going to the region at the beginning of May. So maybe there's some appeasement happening in advance of that. And then lastly, which is not being talked about a ton, you are seeing a larger military presence that the U.S. is exhibiting in the Indian Ocean, with a number of their stealth bombers now parked there, flying distance from Iran. Unclear if there is some additional barrels being added in anticipation of potentially less production. What the market is grappling with right now, I think on the second derivative, supply has gotten more bearish than we thought 4 weeks ago, and on a second derivative basis, demand has clearly gotten more challenged. Is demand going to grow by 300,000 barrels a day or 1 million barrels a day? It's a big unknown. But the volatility and the weakness in price is, I think, sowing some challenge as we look into the future. We're not going to see the production growth that we were expecting or that President Trump was expecting out of the U.S. if oil prices are at $50, $55 a barrel.
Right, I took a detour there because I was personally interested. I got to get back on track.
Sure.
I was supposed to ask you about gold in this run that we've seen. Quite positive.
Yeah, and we've been constructive gold, and we like gold because of the merits it affords in portfolio construction, right? So you see today that there is a flight to safety, and gold is benefiting. We like gold because when we look at what emerging market central banks are doing, we've talked about this, they've been buying gold in a pretty robust manner for the better part of the last 12 to 16 months. And notwithstanding the fact that they've been buying gold, their reserves, their bank reserves are still predominantly like north of 80, 90% sitting in fiat currency, sitting in the US dollar, sitting in the euro. If I was a wealth manager for the central bank, I'd say you probably want to have some diversification in your assets. When we talk to our clients, we're talking to them about the importance of portfolio construction and diversification. You're a central bank, you're the Chinese central bank, the Indian central bank, and all your reserves, or almost all your reserves, are sitting in paper. And we've seen over the course of the last 16 months instances where the US government has confiscated reserves from Russia, from Afghanistan. I don't know that that's the risk that you want to take. It's not necessarily de-dollarization, right? But on the margin, I think it's better portfolio construction.